Welcome everyone to SecretCaps' first ever video lesson on screening for microcaps. Today I'm going to speak with you guys about how to use screening to uncover some microcap gems before the market finds out about them. For the pros who know how to screen, I hope to give you guys some new tools, some new parameters to look for. And for beginners, you could certainly use this as your starting point for screening for microcaps in your own time to uncover some gems. So to get started, one of my favorite screeners that I use is Screener.co. I think it's the most powerful in my opinion. Then we're going to touch on FinViz for a little while because that's another powerful screener that we can use to find some microcap gems. Before we get started, I want to state two things. The first is that screening is a great way to find microcap companies that people have never heard of, that Wall Street's not aware of, or that there's no analyst coverage of. So it's a very powerful tool which every microcap investor should be using. On the other hand, it's just a starting point. So you shouldn't be using screening as your only way to find microcaps. And you should be aware that the data is old. It's not a forward-looking indicator. It's all old information. And you can't get a whole thesis, theme, or a story simply from screening. So make sure you do your own due diligence after you create a watch list and really narrow it down before you begin doing your homework. So first, after you log into Screener.co, which they have a 30-day trial Lenny hooked me up with, you get to your main toolbox page. So from here we could begin to build screens, add conditions and parameters, and build a watch list of companies we want to look at or that we want to dig into a little bit further. So to start off, going up in the top left-hand corner here, we want to look for companies that are microcaps. So we're looking, a lot of people have different definitions on what a microcap is. Some people say under 300 million, some people say under 100, some people say nano cap starts at 50 million. I like to look sub $50 million. Because that's just, I want to find the companies before they're discovered, before there's coverage, mainstream or on Wall Street, on these companies, so I can get in before other people do. So to start off, we're going to add a parameter. So we're going to go to Add Condition, top left corner. We're going to go to Share Related Items, Market Capitalization, and we're going to go to less than sign. We're going to type in 50 million. We're going to see how quickly it narrows the list down from 53,000. So it's just about 21,000 companies that are sub 50 million. That's a lot. If you have a handful of companies in your portfolio, it really narrows it down from there being 21,000 out there to you only having 5 or 10 in your portfolio. Granted, this list does narrow down pretty quickly once we start getting specific. Next thing I want to do is back to the top left-hand corner. Stay within our circle of competence. So to do that, we exclude sectors which we're either one out of our circle of competence, two we're not knowledgeable in, and we can't, we're not pros at looking into that sector or industry, or that we don't want to invest in. So I avoid 4 sectors in particular. First is basic materials, and to do this, you just go to descriptive, sector and industry, and then straight to sector. And you change this to the exclamation point, which means exclude. We can do equals to target individual sectors, but I don't want to exclude all sectors. So we're going to go there. The other one I exclude is financials. I'm not a big fan of looking at banks or valuing them. I went to industry by accident. The next one we want to exclude is healthcare. Not a big fan at analyzing healthcare companies, so we're going to take that off the list. I'm not a big fan of bios. I don't have a problem with binary-based companies, but I'm not a pro at looking into what certain drugs do in clinical trials and all that weighting. Those usually get pumped up pretty quickly as well. The last one I want to avoid is, I think we avoided basic materials already. Healthcare financials. Is utilities. I don't want to look at any utility companies. All right, so we're within our circle of competence. A lot of people know that I like to stick with technology companies, high growth, high revenue, high margin companies dropping a lot of money to the bottom line. We're going to go through that screen as well, a little bit different from this. For now, focusing on our current screen, we have close to 12,000 names, and we could continue to dwindle that down a little bit. The next thing we want to do is we want to find companies that have recently reported to screen out any outdated companies. It's great finding a company with revenue growth and that we love, and to just find out later that it's all the data is from 2005. Data lives on the internet, so there's no reason for it not to be here unless we get rid of it and screen it out. To do that, we do add condition, descriptive, go to filing information, we go to last interim filing, usually go greater than sometime last year, 1201, say December 1st, 2014. That'll dwindle it down pretty, that got rid of about 4,000 names. So now all we're looking at are currently reported companies, companies that have filed their financials or any interim filings within the last year. So we screen out any old companies that we don't want to look at that are outdated. The next thing we want to do is we want to do a country focus. So what I mean by this is, I like to exclude certain countries where I don't want to invest in. So to do that, we go to add condition, descriptive, company, and country located in. Now there's several ways you can do this. I usually go individually. I look at equals, Canada, and then I'll go down to United States. Sometimes I'll look at, Israel, and then there's other ways you can do it where you simply avoid countries you don't want to look at. So if we do the exclamation point again, we go to China. Now we'll exclude all Chinese companies to see what that looks like. It doesn't really dwindle much down, but it dwindles some out. For this screen right now, we're just going to focus on the United States. So any companies located in the U.S. You should focus on Canada. There's a lot of companies, thousands on the venture and on the TSX that are worth looking at. We could do that. You could simply change this value to Canada to look at that. But right now we're just going to focus on the United States for this screen, and that'll dwindle it down pretty significantly. There's nothing wrong with looking at international companies. Sometimes their filings are in different currencies, or they don't file as often, or they follow different rules, so it can get harder to look at. But you shouldn't screen out companies just because of they're located in Canada or another country. An example of that is I found a company called Vironet a few years ago that's located in Israel, and that was a high growth company. They ended up getting purchased at $3.15 a share, higher than we had bought. That article is on Seeking Alpha Pro, and that worked out pretty well for us. So now we're in country United States. The next thing we want to do is you can focus on exchange, but like I said with location, there's I don't like focusing on getting rid of certain exchanges or others, because you never know what exchange a company is going to be on, and if it's a good company, I don't want to screen it out just because it's on a certain exchange. That shouldn't delegate the company. So next what we want to do is, I like to focus on insider ownership, because management is the key to any microcap company. They're the ones executing. There's more of an emphasis on them to have to deliver. These smaller companies don't have as vertical hierarchies that larger companies have, so it's basically shareholders then the managers. So you have to have a competent management team with skin in the game. There's no way we can tell how competent they are by their ownership, but it is a pretty dead giveaway if they have their skin in the game. So we're going to go to add condition, insider trading, insider ownership percent, and just for an example, we'll go to greater than or equal to 20%. We're going to include NA values here. This doesn't completely fill the void, but it's worth stating that we might delete this condition later. But it's very hard to get an accurate insider ownership percent on a microcap stock on a screener. A lot of the filings don't flow in perfectly, and it's hard to compute. So unless you're looking at the filings directly, this could be wrong, off, or it might not be accurate. So it's worth looking into on your own, obviously, afterwards. But screening-wise, you may want to delete this value and not use it, because it can weed out companies that do have a high insider ownership. That's just not being reflected in the screener, because for the screener to pick up that info, it's kind of tough. So save condition. So now we got rid of another 300 names. We're down to 700. Another item we could do is, for example, you could play around with many of these things. I'm just going through an example screen here. But another thing you could look at is institutional ownership. And you do that by institutional percent held. I like to do less than 30%. The reason for this is I like finding companies before analysts know about them and before Wall Street's aware of them. Another reason I do this is because institutions can't sell what they don't own. So they can't manipulate a company, they can't rock it, they can't sell it off, and if the market tanks, and there's not a lot of insider holdings or institutional ownership for that matter, they can't sell it, so that helps. On the flip side of that, it helps if they don't own much, because once the company begins to execute and institutions begin to take a position, that could definitely bolster the share price if institutions get involved and start buying big chunks of microcap companies, which are generally most of the time illiquid. So we'll save that. So now we're down to 360 names. Now another thing we can do, a lot of people have a focus on share structure, and I do as well. Now let me just type this up here. Insider ownership and low institutional. It's kind of like opposites. Another thing people like to look at is share structure of the company. Share structure does matter with the microcap company. You don't want 8 tiers, with 800 million shares outstanding, and it could get murky. If you have a $10 million microcap with over a billion shares outstanding, you're going to be playing in pennies at that point. Not looking to do that specifically. So there are ways to weed that out. That's not to say that there aren't, with all of these parameters, it's not to say that there aren't, companies that could have a high share structure or could have a low insider ownership. That's not to say any of that. This is just to narrow it down and to screen. And specifically with the sectors, is there going to be a healthcare stock out there that we're going to miss? Absolutely. But for everyone we find that works, we'll probably find 9 or 20 or 50 other ones that we can't analyze or we don't know or we'll lose money on. So it's not worth it at that point. So to do the share structure, go to descriptive, shares, and you can go to total shares outstanding, or you can do total public float. As many of you know, the float is what you could currently buy, what's being traded in the market. So a low float, if there's not a lot of shares out there and good news happens or bad news happens, vice versa, the shares could move easily as people start to buy them. So that could be those looking for companies that could move very quickly. That's something to look for, but they're also harder to buy if it's a low float. So we'll go to total shares outstanding, and let's look at sub 100 million shares outstanding. And a lot of companies lower their shares outstanding to get a higher share price to be able to uplist, for example. So it is good to have look for that lower share count, because now we're looking at companies that may have already done a reverse split or something along those lines, and that's out of the way. We're not looking for those companies specifically, but share structure does absolutely matter. The other thing I want to do is avoid one more sector. I don't usually avoid utilities. I did here for this example, but I want to change this to energy. I'm not a big energy guy. Oil and gas, it's just not my forte, so we're going to delete that out. So now we're excluding these 4. Type this up. Share structure, top left. All right. Next, we can look for, and this will really narrow it down. There's several things you can look for here. You can look at, certain income levels, certain balance sheet amounts, financial strengths. There's a lot of ways to play around with this. I don't want to get into each one because they're pretty specific. But if you know what you're looking for, you could definitely look into this. I'm just trying to get you guys the screen to get companies that you can put on your watch list to look into. So we're going to stick with that for now. The other thing I like to, now that we're going to get into the financials, let's get into some financials. So we need, microcaps need cash. We don't want ones that are, forward-looking to do a dilutive raise or something like that. We want companies that are well capitalized. So go to cash and equivalents. Now let's say we're looking for companies with at least 500 grand in the bank. I mean, that's kind of low, but we don't want to exclude any, great gems that are under 10 million that might have 500K in cash. That's a lot to them with a low burn rate. So we're going to keep that at greater than 500 grand. And interestingly, that narrows it down quite a lot. That's the same thing with the reports. I just did include NA so that if it didn't go through, we could check it on our own. Next thing we want to do, so we got financials, we got cash in there. Top left corner here. Next thing we want to do, and this is, these might contradict each other a little bit, but I'm going to go through them anyway. Go to income statement. We go to most recent quarter, and we can go to revenue, most recent quarter. So this will, we're looking for companies that have had revenue in their past reported quarter. Looking at pre-revenue companies is extremely difficult. You're adding another complex layer to an already complex space, which is microcap investing. Investing in pre-revenue companies is pretty much investing in startups. And that's great if you're on Silicon Valley, but we're microcap investors, mostly retail. So we want to look at companies that have revenue. So we'll do greater than 0 for now. This will dwindle it down to a little bit. Next up, we want to look for, and everyone knows what I look for. I look for a few things. I play around with this quite a bit, but what I do look for, revenue. What I do look for are high growth companies with great margins. So high gross margins. You could do net income margin. That might get a little tricky because you could weed out a story in the making. We'll go to profitability ratios, most recent quarter, and then we go to gross margin. So this isn't net income margin, which is the amount of revenue dropped directly to the bottom line, but gross margin is great for SaaS-based companies. Example, SMTP Inc., a company we covered recently. High margins, high growth. It's a viral story, and then as the company grows, they drop even more money to the bottom line, which is one growth avenue. The second growth avenue is their price to earnings begins to get grow. Investors are more willing to reward growth, so that's another reason the price per share would increase. So it's a dual base there, which kind of tells back to having a high gross margin, which is another growth avenue. So go to gross margin most recent quarter. We'll go greater, let's say 40%. So 40% of their revenue is dropping straight to gross profit, which is great for SaaS-based companies, specifically technology companies with low overhead that have a platform for growth. Think Uber here. Think Adobe's recent move. Think Direct Insight with Paybox, but we don't have set numbers on that. But that's basically, I believe, along the same lines. You could think SMTP Inc. here. You could think Research Solutions with their model where people just literally log onto a platform and get their scientific, technical, medical information right like that. Kind of like, you could even think Netflix in a way. Not sure that, haven't looked into that structure specifically. So we'll add condition there. We're down to 44 names. So gross margins. Now this is this screen kind of has a focus on technology, so I don't want to skew anyone away from playing around with this and looking at their fields and what they want to do. This is just an example to get you some names that you can look for on your watch list. And then the last thing I want to do is we want to look at growth rates just for now. So we're going to go down to growth rates. You could do year over year, anything from EPS to revenue and everything in between. These get all confusing. There's a lot going on here with all you can choose from. I like to look at prior quarter because you could see, go to prior quarter revenue change, let's say greater than 0, so any growth. This will obviously weed out any companies that have lost, had negative revenue growth quarter over quarter. So go to greater than 0. And that literally cut our results down from 44 to 22 in half. So that really narrowed down what we were doing over here to what we have. So looking at our list, there's a lot of companies here. I'm looking for some. Silver Sun rings a bell, obviously. I have a full report on them. You could look at other companies. Let me look through this list here. SMTP Inc., there it is. So this is interesting, right next to each other, SMTP and XGTI. XGTI, I wrote a Seeking Alpha Pro article on, one of my only short articles that worked out well a few years ago. The point is that you can't, and I want to emphasize this. The point is that we can click it, view a profile, for example, SMTP Inc. We could see a chart, get descriptive. This is all great. We have everything we want, market cap, revenue. They met our needs. There's obviously a lot of growth, high gross margin, 75% is very attractive. And everyone knows this story. I wrote a 20-page research report on this company, for example. That's in SecretCaps' newsletter section. But the point is that reading this description does not give us the full story, not even close. There's no way we can understand the theme here, the growth strategy, where they're going, how competent is management, what are the moats, barriers to entry, what are they good at, what is their competitors good at. Another example of that is, let's look at their income statement. It doesn't say it here, which is, actually does if we scroll down a little bit. So net income lost 1.8 million. Obviously the story turned around. It's very high growth. We passed on it 6 months ago, but now we're big on this one name. And none of this is a recommendation, just educational. But looking at their negative net income, you'd have no idea that this company competes with Marketo and HubSpot, billion-dollar competitors who run losses every quarter, and yet they have massive PE ratios, and investors are. The point is because these companies, SMTP Inc., HubSpot, Marketo, in this marketing automation or email space, it's focused on revenue growth, market share, traction, and those types of items. So would we know from this, it looks like it's getting worse here, their income, would we know that this might be an interesting company just by looking at this, worthy of investment? Absolutely not. So the point is that you have to dig deeper. And if you did dig deeper on SMTP Inc., you'd find out that it's an amazing story underway, and management is top notch, one of my favorite out there, and that could be seen in my research report, for example. I just want to emphasize this example that screening is a starting point, not an end point. It's just always remember that. XGTI, kind of the opposite story. Looks great here, but I probably wouldn't invest in it personally, just for this purpose. Looking to Silver Sun, would we have any idea that the CEO purchases companies for pennies on the dollar and turns it around and puts it into his company to sell their ERP solutions? I kind of dumb that down a little bit because it's hard to understand without reading my report if you haven't, but there's no way, and that's an excellent company as well, and I'm fond of Mr. Meller and what he's doing over there. So the point is that it's just a starting point, and you should really keep an emphasis on there. If you do like any companies and you're going in between screens, changing things up, just click, add someone to watch list, and Eldorado's right here. And then we can change these parameters around right here, and this will stay here. And then afterwards we can go to Yahoo Finance, for example, break this out. I usually go side by side. I don't want to do it here because it'll screw up the screen, but I usually go side by side with my watch list in Yahoo Finance and look at the companies to try and screen them out. Go from screening to actually digging. And I'll save that digging for another day to do due diligence, but you want to look for what's wrong. That'll definitely speed up your process of weeding out microcaps that you're not interested in. I'm not going to do it right now because this is impromptu and I haven't looked at this company at all. But looking into the company's SEC filings, headlines, management, growth, focus, those items, and more obviously. If you're looking for what's wrong, you can screen companies out instantly. It could have 9 great things about it, 1 bad thing could tank it. So, look for what's wrong, not with what's right, because anything that's wrong could tank your company. So you want to get solid ones on deck. Next one I want to look at, the next screener, is FinViz. A few of my members use this. We're going to go to screener here. So looking at the same types of items, we'll go micro. I don't put a focus on technical analysis at all with microcaps. Most of them are illiquid, which I don't think is a bad thing, because it's better on the upside if you get the story right. The stock will move much faster. But the parameters are a little different on FinViz. We're at 300 million here, but FinViz is free, so we'll go to there. You can do, I don't want to look at target price, so we could do sector. We could focus on, let's say, technology, for example. Country, let's say USA. Go to fundamentals over here. We can't put in cash levels, etc., which I don't like. I like Screener Co because they're a little bit more specific, but FinViz is another way to help you catch names that you might have missed. Let's say extremely high insider ownership. Weirdly, we have the same total, even though the parameters are a bit different. But going to snapshot is what I want to show you. We can look at the company through a great view. We have the view here of the chart, little side bits on all their info on financially, and then we can go right to Yahoo Finance to learn more. Obviously, you don't end your research at a headline, you keep going, but it's just an example. I do like FinViz because it's free, and you can literally scroll down to the next companies that you screened out, but I do like Screener Co because they're so powerful. A lot of companies, example, if we change this to Canada, we could be much more specific on Screener Co, and that's what I like. But you got to, maybe we were a little too specific. If we look at our chart here, if we were less specific, we could have had anywhere from 300 to 12,000 names to look at, and actually around 300 names to look at after our interim filings and sector removals. So I mean, FinViz is pretty powerful with other countries as well, even though there are thousands of microcaps out there. So I want to put an emphasis on screening. I think every investor should use it. I don't think it should be an endpoint for you. I think there's a lot of cons with screening that you should be aware of, such as it's backward-looking data, and then it's not forward-looking at all, and it's just a starting point for your due diligence. But every investor should be screening. You don't have to screen daily. You can if you want to, but the great thing about microcaps is the data doesn't change too quickly, as we all know, unless we're in the earnings season. And then even then, it takes time to reflect. So microcap companies could take quarters or years to play out, as we all know, but it could be very rewarding. So you want to take your time screening through each one. And after you find a list of, let's say we found our list at United States. After we find a list of 10, 20 companies, you have to take your time and dig into these. It could take anywhere from 10, 30 minutes, maybe even an hour to look into each one, even longer. I'm very aware with Silversun. I have no idea what Biscotta is all about. It could be better, it could be worse, I have no idea. The point is I'm never going to get that from looking here. Example. And another direct example I want to give you guys, because it's very interesting, is I found a Nuvo screening. I have a CEO interview with Richard Howe of Nuvo, and I have a report on them. And the point of that story is that company lost their main business line, and they moved over to the Allot sites. They lost their app toolbar, and that company's financials were just declines year over year in revenue and profitability, and you would never know that their new initiatives really, really took off fast just by looking at a screener. So the point is that screening is a starting point. You'll find companies you've never heard of, or maybe even haven't looked at. I see a few here that I haven't seen in a while. But the point is that you have to focus and do your own due diligence and homework afterwards. All right, so I hope this screening video lesson helped all of you out, gave some of my veteran members maybe a new tip to how to screen, and some of my new members or beginners information on how to screen for microcaps. We're going to look forward to doing more video lessons, due diligence, maybe a part 2 on screening to get even more in depth. But you guys should definitely take advantage of the trial, play around with a few of these values, and have fun with it and try and find some new gems. Comment your thoughts below. Interested in your feedback, what you thought of the lesson, and I hope to see you guys on SecretCaps.